Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Mitchell Krause from Other Side Asset Management. We have no mailbag today, but remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show, or write to us at feedback@investorhour.com. For our opening rant this week, Credit Suisse, silver prices, Kim Kardashian, and more. And I'll be joined today by Stansberry Digest editor, my colleague and friend, Corey McLaughlin. That and more right now on the Stansberry Investor Hour. Corey, welcome. How you doing?
I'm good. Happy to be here.
All right. I got a few things on my mind I need to share with you.
Please.
First of all, I think it's impossible to ignore Credit Suisse. And my favorite thing about this is not actually that, Credit Suisse gives me a feeling of 2008. It's that the reporting has been so different on different places. I'll tell you what I mean. So the news is that the CEO came out with this memo to the staff. I haven't seen the memo, but I've seen it reported on a couple of places. So U.S. News and World reports the very first line of their article. Actually, it's a Reuters article that went through U.S. News and World, and they said Credit Suisse has solid capital and liquidity. Chief Executive Ulrich Korner told staff in a memo seen by Reuters on Friday. Right? Solid capital and liquidity. That's the message. Okay. Same memo reported on Bloomberg, and they're talking about a critical moment. In the same memo, it says Credit Suisse is at a critical moment. And then there's another headline this morning that says, this is also on Bloomberg, Credit Suisse market turmoil deepens after memo backfires. So the share price is down. The credit default swaps on Credit Suisse debt are up. I mean,
yeah.
I think it's kind of funny.
It is all commentary on the state of, I guess, financial media and media in general itself. I don't doubt that there's something there to the situation with Credit Suisse. At least I don't doubt, based on what we've seen. But
we know they lost $5 billion on Archegos last.
Right.
Like, that's a major hit.
Right. So there's obviously something there. But yeah, I've seen this kind of. You've read more than me, but I have over the weekend just saw stuff on Twitter, people going wild over, how the bank might be out of business on Monday. That hasn't happened yet, as far as I know. So
it's funny you mentioned Twitter, because I was looking at it this morning too, and some guy from like R.W. Baird, this sort of second, third, whatever tier Wall Street firm, is saying, all the financial tourists are talking about how Credit Suisse is in trouble, and they don't know anything. I thought to myself, behold the mouthpiece of the status quo. I don't know what's going on inside Credit Suisse. They haven't really told anybody, but they're bragging. It's a typical giant bank thing. They brag about having a 14% capital cushion.
Yeah. To your point, though, each of those media outlets picked up a different thing. So from that same memo.
Yeah.
So it's a critical moment. Yeah. They're acknowledging that for their own company.
Right.
And then beyond that, people took it all different kinds of different ways.
Right. Well, the market has been hammered, and debt markets have been hammered. I mean, even I think Apple bonds are yielding like 5%. And so I get it. I get the credit default swaps going up on this levered European bank that nobody's quite sure what the problem is. So yeah, maybe that's just it. And it's silly to extrapolate a crisis, but you and I know how these things work. Cycles are real. They happen. And the usual suspects go south before everybody else. So if Credit Suisse, has a giant problem before everybody else, like, who would be surprised?
Right. And the fact that so many people seem to be very sensitive to the story and paying attention to it just tells you about the
Oh
sentiment
yeah.
in the market in general. That's not taking much to, send people into panic mode. It seems
Right.
more and more.
That can be a contrarian indicator, right? Maybe there's a bounce around here somewhere in the stock market, but still, we're gonna. I mean, if I had to ask you, are we going to hear more stories about distressed European banks in the next 6, 12 months, or fewer stories? I'm going to go with more.
Yeah, I'll take the over on that. Yeah.
So, yeah, right. So the other thing I wanted to talk about, I have to mention this because there's a personal connection. I've been buying some of this silver ETF, SLV. I just, accumulate these things. No big deal, right? And I've talked about gold and silver for eons, so it's no surprise. And it doesn't violate our Stansberry, disclosure stuff.
That's good.
So I can talk about buying an ETF, right? So I wake up this morning and the thing's up 6%. And so I figure, well, I'm going to go look around. And I look at all the usual places. I mean, I look at like the silver news website on the internet. Nothing. I mean, nothing. There's no new. I have no idea why this thing is up almost 7% here as I'm looking at it.
I like that in an
but that's
investment.
good, right?
Yeah, I like that when you're an
Yeah,
investment you
okay.
have goes up for apparently no reason.
Yeah. So, well, yeah, no reason. Maybe, I don't know, maybe Credit Suisse silver. I don't know. Maybe. Who knows? But I think silver has this attribute to it, though. It could be nothing, in other words. Like silver has this spiky kind of attribute. If you look at a really long-term chart, it's not like gold. Gold has overall been in a really decent uptrend in the 21st century. Silver's like spiky. It goes sideways and then, shoots straight up and collapses straight back down. Completely different demand dynamic. So it's a different animal.
When it starts moving, it really starts moving.
Oh yeah, when it starts moving, look out. And it tends to move after gold has moved substantially, which we're still waiting on that one, right? So maybe nothing, but I just thought it was funny. You'd think the typical like silver websites and everybody would be like all over it. Oh yeah, silver's coming back. It's bottom. Let's go. No, nothing.
Yeah. So what do you make of that?
Well, I don't know. I think you have the right take, right? That's what I want to see. I want to see an uptrend that no one is talking about. And this may be the beginning of an uptrend. I don't want to, I don't want to jinx it, but there it is. I put it out there.
Right. Yeah. People have been, silver has obviously been, I read a lot of reports and research on this is silver's time to take off over the past year, much like gold. But it seems until something changes with the overall macro environment, which maybe that's an indication of some expectation for that to change with these different crises popping up now every 2 or 3 days, that the central banks of the world won't have too much more rope to go in their rate hike plans and might need to pivot, which
Right.
you mentioned Twitter before, which a lot of people on the Twitter have been clamoring for or debating about over the past several months.
Yeah, a lot of predictions there. A lot of the Fed can't keep doing this type of talk. And I continue to believe that the paradigm is sort of like peer pressure kind of high school environment where they're influenced locally. They've got to keep inflation down, and they've said it out loud in Washington D.C. where everybody can hear them, and all their friends are looking at them and say, you said you keep inflation down, and that's a pretty strong political talking point, so you better do it. And they seem really committed, and it would be like the Fed to commit to a model and not really care about anything else, right? We're committed to the model. We need to get back down to 2% CPI, and that's all there is to it. So I don't know. I think that's the most reasonable expectation, is all I'm saying.
Yeah, there's a lot we could say about the Fed. I write about it too much. I get tired of it, yet I do it anyway because it seems like the Fed is always involved in the story somehow.
Yeah.
The economic manipulation is incredible, how much influence they have on certain things. But at the same time, there's a lot of things about inflation that they don't have control over, with oil prices and whether corn makes it out of a farm or those sorts of things. So a lot of people are still forgetting.
You can't print oil.
Right. Yeah. People are still forgetting what the Fed can and cannot do. They obviously have a huge effect on the real estate market, but there's other things that
Right.
they don't. And so I keep thinking, okay, if the central banks, like the Bank of England we saw last week, if other central banks start doing those sorts of interventions, basically we're looking at a higher inflation environment moving ahead if the Fed kind of pulls back on these plans that they've
Right.
been talking about and have, to be honest,
Sure.
have been
Yeah.
like executing on for the last 6 months. So
Yeah, you know me, I don't predict anything, but all I know is that they keep saying the same thing and doing the same thing. And I have to believe that in their typical way, an army of 400 PhDs with too many models are saying, they're staying the course, and that's what I expect them to. That, at least, without trying to predict or build expectation, that is the thing that would surprise me the least. Put it that way, is for them to keep doing what they say they're going to do. And like Powell comes out and he's at the last press conference, he was the very first question. It was somebody from Wall Street Journal or something, and they were talking about, what would it look like when you stop raising rates? It's like, and Powell immediately was like, okay, just so you know, nothing has changed since my comments that I made, at that meeting they had
Jackson Hole.
at Jackson Hole. Yeah, just so you know. He's like, I just want to make it clear that nothing has changed. He's like, why are you asking about this? That's what I heard. Why are you even asking?
Right.
It's
Do you not get
ridiculous.
it?
We're raising rates. Yeah. Do you not get it?
Or has anybody been listening to me? Does anybody believe me?
Nobody.
Yeah. No, I'm with you. Yep.
That's enough Fed for now.
Agreed.
And for the rest of our lives, probably.
Yes, please.
So I did want to mention this Kim Kardashian thing, though, just because I thought it was funny. She apparently has settled with the SEC to the tune of, what is it, $1.8 million, because she was found, I don't know if it was guilty. Oh, 1.26 million. Sorry, 1.26 million settlement with the SEC over an investigation into her role in some crypto deal. She was promoting these EMAX tokens, and of course, crypto's been absolutely obliterated off the face of the earth. And they thought it was, they think it's inappropriate. And Gary Gensler went on Twitter and made some statement about it, and which I think is hilarious. I think it's hilarious that Gensler said, this case is a reminder that when celebrities, influencers/influencers endorse investment opportunities, including crypto asset securities, it doesn't mean those investment products are right for all investors. Oh, duh, you think? And yet, I don't know. I feel like there might be a few other things going on that he could pay more attention to than that. Just a few other things, maybe.
Yeah, I think so. I did not anticipate my first appearance on the podcast here to be talking about a Kardashian, but that's where we are, and I'm very okay with that. Yeah, I mean, I'm
Exactly.
I'm glad the SEC is pointing this out to people who may not know it. I am, but yes, there seems to be other. How about the broader crypto regulation discussion? Where are we on that? Obviously,
Right.
this gets headlines too. The SEC, they have been doing a lot of other penalties and whatnot lately. I saw. I can't remember them off the top of my head, but I see their various announcements. This one gets a lot of headlines, obviously, but they're not. I agree with you. They're not. There's obviously bigger fish in the sea here that they could be focusing on.
And really, more broadly, let me ask you this. If we have an SEC that purports to protect investors, however they purport to do it, in this case, like through the threat of some kind of fine or prosecution or investigation after the fact, however they purport to protect investors, do they do investors any kind of service or not? I don't know. By merely purporting to protect them and not truly protecting them before the fact. Like, people have lost their asses in this stuff. It's, some of it is just down 99.99999%. There's like thousands upon thousands upon thousands of these cryptos, most of which have been absolutely, completely obliterated. And in general, like, what am I going to behave better as an investor if I know that I'm completely exposed to the risk and nobody's coming to help me, or if I think the SEC and the Fed have my back?
Yeah, it's like that typical government slow to recognize or respond to what is actually happening in the real world, either because the government's too big or they're just not, there's innovations that are happening faster than they're able to keep up with. It's happened forever. The SEC limited resources, I think, as far as keeping up with the thousands of cryptos that are out there. Yeah, again, I don't know what else to say, much else to say about it other than I'm glad they're pointing out that not to believe everything you see on Instagram, I guess. But
Sure.
other than that,
Sure.
yeah, there's a lot of other things that could be done instead.
And if they didn't tell us that and you believed what you saw on Instagram and it hurt you real bad, would you not learn? Would you not learn better? I don't know. It seems maybe a little cruel, but I don't know. I am really skeptical that they're protecting anyone truly. I mean, I think they're protecting their careers more than anything. I think they're looking for a job at Goldman more than anything. I just do. But anyway, that's always where I go. I see this thing on Kim Kardashian, and aside from the absurdity of having her face on the front page of the Wall Street Journal, I automatically go there because it's sort of like that insurance thing I bring up every now and then. I forget who originally said this, but it was some guy who was talking about car insurance, and he said, "Well, I could eliminate all accidents overnight, even fender benders, simply by requiring every automobile be built with, no seatbelts or anything, and just a 6-inch steel spike coming out of the steering wheel aimed at the driver's heart. People would drive a lot more carefully." And the point is, you're exposed to all the risk, right? No one is telling you that wear seatbelts and now you'll be safe. Of course, you wear seatbelts and you drive faster. I mean, we always compensate our risk tolerance and aversion. It's a complicated interplay. So when you tell me that the SEC has my back and the Fed has my back and there are, what do they call them? Circuit breakers in place if the market starts melting down. I just go, really?
Who's in control of those circuit breakers anyway?
Yeah. Yeah. What if they fail? Are you telling me they can't fail? The SEC can't fail. The Fed can't fail. The circuit breakers can't fail. I don't believe it. I think people are in markets the way fish are in water, and I don't think we control the wind and the tide and the waves and anything else.
I'm with you.
But, that's just me. That's just Dan.
No, I'm with you. I mean, obviously, we've seen just recently what the Fed can and cannot do. They said, "Oh, inflation's transitory." It's taken me one appearance to say Fed transitory on here too, but and it wasn't, and so that led to a lot of where we are today. I mean,
so Fed transitory. We got Fed transitory. We got Kim Kardashian. Is there any other buzzword we need to hit? Because we got to move on here.
No, we'll save buzzwords? The next one for next time if you have.
Okay. All right. More buzzwords coming from Dan and Corey next week. All right. Let's move on. Let's talk with Simeon Hyman from ProShares, the ETF company. Let's do it right now. Please pay close attention right now. The next 30 seconds could make up for all your stock market losses this year and even maybe save your retirement. You'll have a rare chance to hear from two Wall Street legends, Mark Chaikin and Joel Littman. What Mark and Joel are going to share with you on September 22nd could make or break your retirement, a way to make 5 times your money, even if the market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes, depending on which side you're on. Let's face it, the stock market's been a minefield this year with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't really safe anymore. Your money is losing value even as we speak at a rate we haven't seen since the 1980s. They'll be giving you a financial lifeline that could erase this year's losses for you and trigger a wave of potential wealth. It's so powerful, it could save your retirement. For a sneak peek of Mark and Joel's big reveal, go to September22warning.com. That's September22warning.com. Simeon, welcome to the show. Good to have you back.
Thanks so much for having me.
Yeah, so I'm really happy to have guests like you back for a second time because things have changed so much since the first time, and there's a lot going on. The big items being, inflation, rising interest rates, markets getting absolutely crushed. And, now then we're also seeing these like waves of sovereign debt issues. There's a lot going on. War in Ukraine. I mean, it's just really a crazy time, it seems, all of a sudden. But, these things build up over years. So for you, like, we talked before we hit the record button, and I know for you, like, inflation and rising rates are probably something you have some thoughts about for us today, yes?
Indeed. And I'm going to probably be just at least a smidgen more optimistic than some of the folks you may be talking to. And
Bring it.
I'll give you a couple of sources for that. First, there's been a lot of talk about, the Fed being way behind the curve. And, is the Fed accomplishing anything? We've seen inflation look pretty darn persistent. Even if we're at a peak, it's likely to persist a little bit longer and linger, certainly north of the 2% Fed target. But let me give you a data point that suggests that maybe the Fed's at least getting a lot of its job done. And I'm going to point to break even inflation. So, this is where you get the market's take on what future inflation will be. And I'm looking at my screen, and I see that the break even inflation on the in a 2-year time period, so 2-year break evens, just went below 2%. Well, there you go. I mean, that is the objective. And at least just 2 years from now, we're not even talking 10 years from now, the market is voting and saying, yes, we think inflation will be back, in that realm. Now, what the path over the next 2 years is and how hard or soft that landing will be, let's get to that in a minute. But I think a lot of our folks who will be giving us some of their time and listening to this podcast might not be aware that, hey, that 2-year break even is below the 2% target of the Fed's inflation rate.
Right. I wonder what the market was saying before it hit 8%. But
Well, so to put it in context, it peaked last March at just under 5. So it did poke up. It's not as though it hasn't moved. It has come down substantially in the last 6 months.
yeah, inflation is I tend to think it's a stickier phenomenon, but you know what, Simeon, I'm not going to rain on your parade. I want all your mojo here, and I know our listeners do too. So that's good news, right? I mean, 2 years it probably feels like a slog at this point. We feel like we've lived a decade in 9 months here. So you think the prospects then for rates are probably going to follow along with that, right?
So here's my slightly less optimistic view on the rate side. I couldn't give you a straight bullish view here because we've got phenomenon right now known as quantitative tightening. And that's not getting enough press lately, not getting spoken about nearly enough. And what quantitative tightening is it is it is the opposite of quantitative easing. So let's unpack that for a second. Prior to the great financial crisis, the Federal Reserve only controlled one thing: the overnight lending rate. And those of us on the strategist side, we had a standard party line. The Fed only controls the overnight lending rate, and the market determines the interest rates further out on the yield curve, whether it be 1 year, 2 year, 5 years, 10 years, 30 years. And then Ben Bernanke showed up, and I heard that he wrote this in a PhD dissertation as a theory. Well, you know what? What if the central bank buys bonds of longer maturities? Then the central bank can suppress longer term interest rates. In other words, not just take the overnight rate to zero, but suppress the longer term ones and further stimulate the economy. And we did it. In fact, we did it twice because we did it, or I should say, the Federal Reserve Bank did it out of the great financial crisis, and then again in ramped up again in the pandemic. Now it's unwinding, and it's unwinding. The pace of the unwind actually doubled at the beginning of September this year to $95 billion a month. And what that means, that is the removal of the artificial suppression of longer term rates. And that means that interest rates can rise even if inflation comes down. Case in point, we just referenced that over the last 6 months, the break even inflation numbers are coming down, but interest rates are going up. That's exactly what quantitative tightening is accomplishing. It is the allowing of real interest rates, meaning the yield over and above inflation, to rise and normalize. So I think there's more room for interest rates to rise, even with some optimism on the inflation front.
All right. So a tempered view, but overall, you can handle. I would like to think we could handle the rising rates better with a more stable economic picture, because people do get hurt a lot by inflation, so they pull in the belt strings. So I wonder, do we still get folks like I don't know? I guess the latest one was Stanley Druckenmiller and others. Dalio, all these macro guys. Their outlook is really dire. I mean, they're talking about a potentially really bad recession in 2023. How would that figure into your outlook? You sound like you're not there? Maybe.
I suppose I see things as a little bit softer on the landing than some others, and I'll give you one reason that I think um, is an important one, and it's domestically focused. It's kind of like a modest version of what happened post World War II. In the U.S., we had a several decade run of growth that was substantially outsized the rest of the world. And a lot of that was because post World War II, a lot of the rest of the world was not in shape to produce things the way they were prior to, sadly, that unfortunate geopolitical conflict. And we've got some of that right now. Um, China is a mess coming out of COVID, and very sadly, we do have a war in Europe, and that is really screwing up the European economy and, of course, the energy markets there. And we pray for a peaceful resolution. And so now, for the first time in a generation or two, we've got companies outside the U.S. thinking about making things in the U.S. So I think there's perhaps a little bit of an opportunity for the domestic economy to land a little softer. I know that we're, as much as there's been a slight slowing of globalization in the last few years, which I don't want to go down that rabbit hole, but let's just say there is a little bit of a less globalization, but we aren't an isolated country. And we saw what happened recently with a little bit of chaos in the UK with regards to their fiscal choices and monetary intervention. So we're not totally isolated, but maybe the old cleanest shirt and the dirty laundry story has a little bit to do with my perspective of a slightly softer landing than some other folks are anticipating.
Right. That's kind of where a lot of people wind up on the U.S., isn't it? It's like, even the guys who are really talking about a serious global sovereign debt crisis are all saying, well, the problem is, of course, that they all need dollars. So it's hard to envision demand for dollars going down. So, capital flies to the US, and this dollar milkshake theory that people are talking about is like Dow, dollar, and gold are all going to go up, with maybe gold as the last man standing. Do you worry about any of that? Do you worry about, what we're seeing in Japan? I mean, the interventions are coming hot and heavy, I feel like. Japan,
Well,
England.
I'm certainly not in the camp of worrying about the bond vigilantes. The As much as I made the case that interest rates, can rise in the U.S. notwithstanding optimism on the inflation front, that's more of a function of quantitative tightening. The bond vigilantes have never really emerged to the extent that folks have thought, particularly because the dollar is still the reserve currency around the world. So I think there's very little risk of the kind of potential instability with regards to currency and sovereign debt markets that you could see in Japan or we see a little bit in the UK. I think the US will be somewhat isolated from that. I think the investment implications are getting perhaps a little. I'll say confused of late, and let me explain what I mean by that. If you think interest rates still have some room to rise, so the answer is part of the answer may be okay. If I'm going to invest in fixed income, I must have shorter maturity bonds and shorten my duration. Duration being how long it takes you to get your money back, and that duration is also the measure of sensitivity to rising rates. So you say, okay, well, I'm going to have short duration bonds to have the least sensitivity to rising rates, and I'll be protected that way. And hey, the short end has gone up. I mean, the 2 years over 4%, so that's not a bad idea. But the overextension of that thought process to equities is, I think, a little bit of the overgeneralization that we see, because you can turn on your TV and see some pundits talk about short duration equities. Now, what the heck is that? Because duration's kind of a bond term. Well, okay, let's try to map it over and see what it means. If duration means how long it takes me to get my money back, so what some folks are saying is if you have stocks that are taking a longer time to get your money back, then they may be more sensitive to rising rates. The problem with that is if you take that too simplistically, you're going to buy the cheapest stocks that aren't growing at all, because if they're not growing at all, that means more of your money's coming now. Well, guess what? If you buy a stock that isn't growing its earnings or dividends, guess what you bought? You basically bought a bond with a fixed coupon, and that's the thing that's most exposed to rising interest rates and inflation. You have to step back for a minute and remind yourself that the salvation in equities is growth. I mean, that is why over the decades, equities are the thing that deliver the best real return in excess of inflation. So, sort of looking for no growth equities doesn't make any sense. Then the question is, how do you prudently look for growth? Because I'm not suggesting that, this is the greatest environment for speculative things that might not pan out for 100 years. But what I am suggesting is prudently for us, we think if focusing on companies that have consistently grown their dividends is a great source of both stability and inflation protection. Because number one, let's take the S&P 500 dividend aristocrats. We track it in our ETF, NOBL, Noble. These companies grew their dividends 25 straight years. The only way you do that is by doing it in tough environments like the great financial crisis. And one of the ways you got to pull that off is by having some pricing power. So what's a concern in an inflationary environment? A concern is margin compression. Input prices go up more than you can raise your prices to your buyers. And in fact, in the S&P 500 in Q1 and Q2 of this year, margins have compressed. The S&P 500 dividend aristocrats have actually expanded margins. So that's driven a lot of downside protection this year. But of course, if you only have an investment strategy that offers downside protection, you better have the crystal ball that tells you when the bottom is. The beauty of dividend growth is that on the other side of this, the dividends are growing. They're growing faster than the dividends. The S&P 500 aristocrats have grown dividends faster than the S&P 500 and at a 12% historical compound growth rate, even faster than the inflation that we've seen. So, I think that's one issue for investors is don't just think that you got to buy these dirt cheap stocks, because if they're not growing anything at all, they can actually be really exposed to rising interest rates. And I think the other pocket of opportunity, it is switching to the fixed income market, I'm probably a little bit more optimistic about credit. And look, people have, there's been a recent, in fact, there was an interesting pullback from a leveraged loan deal that hit some of the headlines, and there are some stresses out there. But I want to make a distinction here. If a company has fixed coupon debt, that's like having a fixed rate mortgage. So if inflation is going up, it actually gets a little easier to pay off those obligations. I said that margins were compression. So think about it this way. Let's just round up that inflation number. This is not a projection. I'm just rounding up for simple math. Let's say inflation's 10%. And let's say therefore that I'm a company and my top line went up 10%. But now let's say that my bottom line only went up 5 because I couldn't quite raise my prices enough to offset the rise in input cost. So there's 10% on the top and there's only 5% on the bottom. You know what you're paying those fixed debts with? The 10% increase, because you got to pay that off before you get to the bottom line. So it's just like having a fixed rate mortgage. I think there's a little bit of opportunity, especially on the investment grade side of corporate debt. But by the way, I mentioned that headline with regards to leveraged loans. There are floating rate corporate debt options out there, and those don't have the benefit, because you think, I am protected from rising interest rates because the yield, the coupons keep going up if there's inflation and rising rates. The problem is, guess who's got to make you whole? The company that issued the debt. Well, that's stressing them out, and they could have a lot of their credit quality could go down. And then when that happens, then the spreads widen and the price of the bonds go down. So that's kind of like the wrong side of the trade in this environment. You think you want to go to those floating rate things because you're worried about rising rates. And then meanwhile, you're actually buying bonds that are getting stressed because the companies have to pay more and more. The alternative, which we do in our interest rate hedge bond ETFs, we have IGHG is investment grade, HYHG is high yield, is we take a portfolio, an index portfolio of just long fixed coupon bonds enjoying this benefit, and then you hedge the interest rate risk by just shorting treasuries. So that way you're not stressed. The companies underlying are not being stressed because they're paying fixed coupons like a fixed rate mortgage, and you hedge yourself. And it's a great little bit of alchemy that can be an interesting spot as we look towards the end of this year and the beginning of 2023.
Very interesting. I find of all the things you just said, I'm sort of stuck on the dividend aristocrats idea, because I just looking at the top 10 holdings, I don't know how current this is, but it's like Nucor, Target, ExxonMobil, and Roper, Cintas, Cincinnati Financial. It's a very interesting kind of eclectic mix of businesses. And I could see where, this mix would kind of do better, especially as you point out over the last 2 decades when there's been so much to kind of throw off your dividend growth schedule, and they've all made it through that and kept growing the dividend.
It's it's been a very attractive strategy over the many years, and it really does have some extra oomph in a turbulent environment with a little bit of hotness on the inflation and interest rate front. And I should mention that the strategies there are a lot of folks who've heard about dividend growth strategies. First of all, make sure that you distinguish that from high dividend yielding strategies. So don't go buy the highest yielding equities, because again, those are the things that can be very interest rate sensitive. So first, we're in the dividend growth camp, companies that have grown their dividends, but also the strategy is particularly effective not just in large cap, but even in mid and small cap. It can be a very effective strategy. The S&P 400 Dividend Aristocrats, REGL, has attracted a lot of attention this year because you have, from a broad perspective, you have a valuation opportunity. Mid and small cap stocks are trading at half the valuation they were a decade ago relative to large. But the challenge is you can get a little riskier as you go down in cap. But if you pursue the high quality dividend growers in mid and small cap, and SMDV is our small cap dividend grower, that can be a way to try to capture some of this advantage of valuation in a more prudent way. And by the way, particularly in mid caps, the earnings seasons, the earnings growth has actually been stronger in mid caps than large cap this year.
Yeah, and I just want our listeners to know, Simeon, that I raid ETFs like this for ideas. Like I'll look through something like SMDV because there's lots of stocks in there and lots of better quality ones. So that folks may not have heard of before, right? They've heard of the Targets and the Exxon Mobil's and stuff.
It's a great point, and also it can be particularly in small cap, it can be a little counterintuitive because you wonder who are these companies that grow their dividends but don't become big companies. And the answer is, first of all, it's not a lot. So out of the Russell 2000, I think the count of the dividend growers in small cap that are in the index and the fund, I think, is in the 60s. So it's not a huge proportion, but they are a clever little animal because they can be smaller, perhaps closely held companies that they're not doing dumb acquisitions. They're not buying private jets. They're not wasting money. So they're staying small. But you know what they're doing? They're sharing that cash flow in the form of increasing dividends. So you're along for the ride. So if it's like a Tootsie Roll where the chairman and the CEO is one person and a part of a family holding that has a concentrated position, you say, well, wow, that violates some governance standards. Well, okay, maybe. So CalPERS and CalSTRS and Texas teachers might have to take a pass. But if they're sharing that cash flow in the form of consistently increasing dividends, I say maybe it's okay to be on the along for the ride.
Yeah, absolutely. In fact, you and I both know like a great way to look for stocks is to figure out all the stuff that CalPERS can't buy, right? And because it's going to be covered probably a little bit less. And just looking through the top 10 of SMDV, again, I'm not sure how current my list is that I'm looking at, but it's like folks have probably heard of WD-40, but the rest of these, like Badger Meter, God, that's been around forever, hasn't it? Cohen and Steers, maybe, but the rest of them, I don't know. It's an interesting list.
It's an interesting list, and it's kind of a place where the do-it-yourselfers also tend to stop.
Mhm.
I mean, first we obviously have an ETF is a great packaged way to get diversification. By the way, these are equally weighted strategies, so it keeps you away from the my fund my portfolio is driven by two stocks, so the equal weighting takes care of that. They're rebalanced every quarter, so it's all stuff that is just kind of cumbersome if you're going to do it yourself. But there are also just very few people who want to do due diligence on smaller companies too. So that becomes an interesting part of the value proposition too. The other thing I would mention is if you do look at both REGL midcap and SMDV small, you'll actually see a little bit more representation from banks and financial services companies than you do in large cap dividend growers. And part of that was the financial crisis, took out the dividend, at least either eliminated or slow or stopped the dividend growth for banks, and that's more than 25 years ago. But it is kind of a cool opportunity because one thing we note is that the smaller regional banks often have a little less, let's call it headline risk, and they may be a cleaner play on this notion of quantitative tightening, pushing up even longer term interest rates.
Yeah, again, REGL, I'm sorry, REGL, a really interesting list in the top 10. And like none of these that I'm naming, like the top 10 are not 20% of assets in any of these.
Equally weighted. So if it's 60 odd names, they're less than 2% positions.
Pretty cool. And I have to point out in REGL, we've covered Brown and Brown, awesome business, and Lincoln Electric we covered at one point too. And really interesting other stuff. UGI, utility company, John Wiley and Sons, the publisher, Old Republic International, another insurance company, been around forever, Nordson Corp. Really interesting lists. As I said, I like this aspect of this because we're a top-down sort of one stock at a time firm, and these are wonderful places to look because
Well, That's what these I like to call them rules based strategies. We follow an index, but it's a set of rules. So in other words, I don't wake up in the morning and pick these stocks. These indices are we partner with S&P and Russell on them, and they have the rule set. And it is a great disciplined way to invest in these ideas. In other words, you could have had a mutual fund PM sort of follow some of these ideas and not some of these ideas, and then they'd wake up and decide they want to do something differently. So if you thought your mutual fund PM was sort of a dividend growth person, but then they kind of got nervous and they figured they had to pile into tech stocks last year just the wrong time. This can't happen here. It's rules based. And I used to run due diligence many years ago at one of the large wirehouses, and when we ran due diligence on old school separately managed accounts and mutual funds, we used to prefer the folks who were mostly screen. That about 95% of their process was a screen, and then they tweak it a tiny bit, and we like that because they'd be less likely to wake up in the morning and do something weird. Well, if you're 95% screen, you know what? Let's just make it 100% and make it an absolute disciplined approach to a well thought out investment strategy and stock selection process.
Right. So let's come at this a different way then. I'm going to ask you a different question, which would probably not come from retail folks. It probably will come from some managers who might say, look, all these ETFs have benefited greatly from the enormous movement of assets out of active strategies into passive, so-called passive ones. I mean, we'll just accept that term for a minute. That's a rabbit hole. But can this all go into reverse? I mean, what if, because right now the indexes are getting pummeled, right? Everything is just getting pummeled, and there's no, it seems almost indiscriminate. It's getting to the point of almost being indiscriminate. I saw, as we speak, Nike was just opened up like down 13%. And that's a big, high quality, people like that company. So what do you tell me? If I'm the manager, I'm expressing these concerns, what do you tell me?
Well, I think the key for what you said was putting passive in quotes, and we don't want to go down the rabbit hole, but when you own a fund, an ETF like Noble that follows those S&P 500 aristocrats, you own 65 odd equally weighted names curated out of the S&P 500. It's a disciplined stock picking strategy.
Right.
And that's, as an example, this year, the downside protection has been quite meaningful. So
Right.
that isn't owning the broad index. Now, by the way, I think broad indexes also will probably continue to get some market share from active management over time. The track record of old school stock picking just isn't stellar, even in turbulent markets. But whatever you want to call it, so I don't like smart beta. I keep saying rules based. I think that is a place where, as an investor, you don't have, your alternative is not just I either invest in the S&P 500 or I invest in an actively managed mutual fund. There are very well thought out rules based ETFs like our dividend growth suite that offer a compelling alternative that lies somewhere in the middle there, and those are continuing to grow market share as well.
Yeah. And for our listeners' sake, I need to point this out. I need to underscore what you just said. It is very different to have what is basically, I mean, the index, the S&P 500, it's an index fund is a simple algorithm. Receive $1 of capital, buy $1 of equity. It's all market cap weighted. So, you buy more Apple than anything, and because it's the biggest market cap. Whereas what Simeon is describing is really quite different. It may not look extremely different, but it is quite different. As he keeps saying, it's highly disciplined. Just the equal weighting is completely different and makes it a much more disciplined strategy. I guess what I'm talking about is a phenomenon that could hit the pure index funds, but certainly is probably not a problem in the strategies you're talking about. They are, in fact, I agree, they're highly disciplined and very different from that simple algorithm of getting a dollar and shoving it into a cap-weighted strategy. I'm glad you brought that up, actually. That's a great point, and it's one I wish I talked about it more. Maybe we need to have you on more.
Happy to join anytime.
So, I have to get to my own concerns. I'm glad that you brought up all the topics you've discussed, but if we're just two guys sitting around in a bar, I mean, you sell ETFs, I sell stock picks. We're both in a tough boat right now. um, it's hard to own anything right now, isn't it? I mean, no.
So let's start from the old school, financial advisor piece of paper, and we talk to a lot of financial advisors and RIAs, and there are a lot of the folks who are, folks who utilize our ETFs for their clients, and um, some of the simple but critically important, just little vignettes that they share with their clients are super, super powerful. And, you've probably seen the little piece of paper that says, if you missed the, 5 best days in the stock market in the last 100 years, your returns would be bad, bad. And if you missed the 10 of them, bad. So there's so many ways to remind oneself that it is so hard to to really time the market in a way that won't be detrimental to most investors' performance. So staying invested is really important, and you stay invested in a couple of different ways. We just talked about one way, which is to have a disciplined investment strategy that can protect you from some of the downside of turbulent markets. And of course, the other way of making sure you stay invested is to make sure that your asset allocation, the structure of your portfolio is right. I mean, there is a reason why it's funny how labels change, but good investment strategies don't change that much. So in the formal pension and endowment space, there is a strategy called liability driven investing. LDI is the acronym. And it just means that you want the profile of your investments and the kind of time horizon of them to match what your liabilities are. And so if you've got to pay out some benefits in the next 1, 2, or 3 years, you're going to want to fund that, and on the investment side with some short-term fixed income. And then obligations that you have way out there, 10 or 20 or more years, that's the stuff that you invest in equities. And the strategy, sort of particularly after the financial crisis, became more popular for individual investors, and people started to talk about LDI for the individual investor, and then some people started to call it goals-based investing. And meanwhile, advisors have been suggesting that their clients own bond ladders for 3 to 5 years, and then an equity portfolio for their longer term needs to keep up with inflation and real returns. And those are the exact same things. So I think it is challenging to stay invested, but it is critically important to do so. And the two ways you do that is have your risk assets like equities in disciplined strategies that can give you some protection. And by the way, also those growing dividends, that's a good way to stay in your seat. Your dividends went up. And also to make sure that you have that appropriate allocation to lower risk assets so that you don't need to sell those equities anytime soon, because you got enough low risk stuff for, whether it be 1, 2, or 3 years of, whatever your cash flow needs are.
I know you said it's hard, but you make it sound so darn easy. You make it sound positive.
And the other thing you can do is just not look at your statements.
That's right. Right. Don't turn the TV on. Don't look at
Don't
stock
turn
quotes.
it on. I literally I do so much travel for to work with as I mentioned, advisors and RIAs, Yeah, I once went into to an office of a substantial size firm, and we were sitting for just a couple of minutes waiting for the principals to come and meet with us and do their due diligence. And they had the TV on in the reception area, and I think it was on like the outdoor channel. And they came in, and I said, "Why is the outdoor channel on? Why don't you have CNBC on?" And the founder of the firm said, "That's our job. That ain't the person's job who's sitting there waiting for us to tell them how we're helping them. We want them to watch the outdoor channels." So yes, indeed. One answer to this is don't look. I mean, remember, even if you're just a few years from retiring, my mother's 99. Even the date of retirement doesn't really shorten the duration of your investment horizon all that much. So most of us, knock on wood, probably have some time left on this earth. So that's you got to make sure that you have those investments that can grow over the long term, even if this year feels a little tough.
So, Simeon, I feel like you've teed up my classic final question that is the same for every guest here. No matter what the topic, even if we're not discussing finance, same final question, which is, if you could leave our listener with a single thought today, what would it be?
Yeah, I think the number one thing right now is just don't blink. If you want to, if you're 70-30 and you want to go 60-40, fine, but don't go from 70-30 to zero stocks and 100% cash. And do not blink. A little tweaking is fine, but for the most part, most of us with some time left on this earth need to stay invested.
All right, to the point, straight to the point. Thank you for that. And thanks for being here, man. It was great to have you back, and we look forward to doing so again in the near future. I bet we'll be having a completely different conversation with making some of the very same points, a year from now or 6 months or something.
You never get bored in these jobs, so thank you for having me.
You bet. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's nightmare winter. Woo! You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, and the US, plus 3 large properties in Europe. And I've been to one of them. It's gorgeous, gorgeous chateau. And I've known Bill for many, many years. He hired me into this business. And he says we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. And he's made 3 similar predictions in his 50-plus year career. And each time it proved to be exactly right, although he was mocked each and every time. And I remember all of them. This is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report that we've put together called America's Nightmare Winter. Get the facts yourself. Go to www.nightmarewinterscenario.com to get your free copy of this report. Even if he's only partially right, it'll dramatically affect you and your money. So again, go to www.nightmarewinterscenario for this free report. Well, it's good to hear an optimistic viewpoint. It really is. And we do overlap because what have I said? I've said prepare, don't predict. I said don't sell all your stocks and go to cash and be totally scared. I've said to prepare for a wide range of outcomes. So your portfolio, if it's truly diversified, you got to have plenty of cash because that's the ultimate diversifier. But you got to have plenty of good stocks. I think you should have some gold and silver. I used to say have a little bit of Bitcoin, but for me, that's a more speculative thing than it used to be because it just never behaved like a store of value and certainly not a currency. It's just not there yet. But if you want to hold a teeny bit of that, consider it a long-term speculation with money that you can afford to lose. But the other stuff is the core. Plenty of cash, stocks in good companies, and some of the strategies Simeon talked about I think are a great way to do it. Especially like those dividend growers over the long term. and gold and silver. I think those three kind of core elements will have you nicely diversified, and then you can do other things around that. Maybe you know something about real estate, maybe you know something about all kinds of other assets, like collectibles, art, whatever. That's on you. But I think those core assets are really important, and I think Simeon gave some pretty good ideas for folks who don't want to get bogged down with picking a lot of stocks. I live to be bogged down with picking stocks, so I'm going to go into his funds and, raid them for individual ideas. Maybe you want to do the same. That was a good talk. We sort of needed to hear that right now, I think, because that is a piece of the overall pie. It's an ongoing piece of an overall good strategy, even given what's happening in the world right now, which makes it, I think it makes it hard to own anything. We have to be honest about that. All right, good talk.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.